Welcome to this very special episode of Investor's Guide in our continued attempt to bring you face to face with the people who run our mutual funds. Today we are in conversation with Bala of Birla Sun Life Mutual Fund. Bala, thank you so much for speaking with us. I appreciate your time. I know you're a busy man. I actually want to understand from you very simply, this is in the market that we're looking at, and you've been at the helm of this company for about 7 years now. Not the easiest 7 years in the equity market. It's been a tough 7 years. How are you and your fund management team viewing this market going forward from where we are right now?
I think having spent more than 20 years in the mutual fund industry and having been head of the business for the last 7 years as CEO of the business, and these questions every time is asked.
Yes.
And I am specifically mentioning this because every now and then we try and make an attempt what will be the market outlook and how things will evolve. Uncertainty comes and goes. But if I look back in the last 20 years and how it got evolved, and I am still holding my view that how it will actually even going forward could pan out, we are quite bullish as a fund house.
Okay.
And when I mean bullish, I think the orderly growth that we should expect from the economic growth point of view, I think we should see that coming back reasonably in a big way.
It's taking some time though to reflect in the market, and at this point a lot of investors will turn around and say, yes, you've been promising us, and by you I mean both of us. We've been talking about this for a while. You've been on the show. We've also been around for 7 years.
Exactly.
And we've been talking about the fact that, you know, over the long term that we will see returns in equity. Over the long term, if you do an SIP, if you do it monthly, we will see returns. There might be the odd investor who turns around and says, where is the return? Because in the last 7 years, we've seen a choppy market. We haven't really seen an out-and-out bull run. Has the nature of the market changed? Is this the new normal? Is this what we should be prepared for?
No, I don't think it's the new normal. I think one has to accept the fact, which normally happens in even our own individual life. It happens in our own company in which you work for. Every momentum it is sustains for a certain period. Then it goes through a dull period. Again it picks up momentum. Unless you have this kind of ups and downs, and then actually and then keep growing up, then you will never understand the kind of money that one can make at what ease and what speed and what kind of easiness that at which one can make. One mistake which I always tell people, actually, you should never measure your performance in the short term, and you always measure your performance in the longer term. And the longer term definition, a lot of people ask, is as long as possible. So if it is a 10 years, be 10 years and have the questions there.
So let's talk about 10 years, because I know that since you are looking at a 10-year investment horizon right now, you must have done some sort of back of the envelope calculation. For anybody who's watching who has 10 years, who's investing in equity mutual funds, SIP, following all the rules we put down, which is simply that keep it very simple, invest in an SIP, don't make sudden changes, don't pull out your money if the market crashes, just do an SIP.
Yeah.
What kind of a return can that person expect, average from an equity mutual fund, diversified?
See, if you just take the Sensex and Nifty and the mutual fund, there are three types you have to take. So 10-year and SIP on Sensex, the least would have gained about 13 or 14%. The best would have gained about 14-15%.
Yes.
In the Nifty and Sensex, if you take comparison. If you shift this actually to the mutual fund diverse actively managed funds, most of the money manager has given outperformance to both Sensex and Nifty, ranging from 3 to 4% after expenses. So the after expenses they are given outperform about 3 to 4%. Which essentially means whatever the number I have mentioned, you add it by another 3% or 4%, depending upon which schemes in which you have done. The another interesting aspect which I want to just highlight, when having spent 20 years in the market, historically I have seen at every 3-year period or 4-year period, we used to get with some scam or other, and we used to get like technology bubble globally that came and hit us.
Yes.
Then we saw a recession in 2002, and we also saw some securities scam. Multiple security scams we have seen in the country, and not just only in India, even globally we have seen. We have seen one of the worst crises for globally in 2008 period, and most of the time after all the crisis got over, all of us used to feel that the market is going to go up or not. When I look back, all these crises short-lived.
So the last time you met with your equity fund management team, what instruction did you give them?
It's ultimately we are managing hard-earned money of public. Therefore, we need to manage the money in a manner that delivers actually the longer-term return, which is more or less better than the market. So the question is it something which is difficult? It may not be difficult. At the same time, when you deep dive, you may find it a little difficult. Therefore, one has to follow the process. See, the market may go up and down, but my process cannot change. When I'm in process, the way you look at investing in a company, the way you look at investing in a company for investing in for learning. So we are in the business of both lending as well as we are in the business of investing in stocks.
Right.
And when you look at these companies, you look at actually the company independent of in which they are operating. The first company is bottom-up fundamental research. That's why we actually, one of the principles we follow, we call it as a science and art. Any investment, there is a science part.
Okay.
Science is something is about to go deep dive into the understanding the sectors, understanding the business dynamics, understand various variables that are affecting actually the business environment. Then art is something which comes on the basis of how much you want to buy this company, how much actually you want to put take a bet on this company, and how much is the money you can lend to this company. To link to that is the balance sheet size.
How much of my decision of choosing a fund needs to be based on the individual fund manager who's running it and his personal track record? Or how much of it should be based on the long-term returns that the fund has shown?
I think we'll have to look at it from multiple angles. One, the people of course who are managing. Ultimately, the biggest assets for mutual fund, asset managers like us, is the people. And second is these people actually represent what kind of firm. What is their long-term commitment from shareholders' perspectives? Right. So I always say that business like us are going to be there for generation. So they're not here for one generation or two generations. They're going to be there for generation. Therefore, one has to put a faith on that as well. Then the third comes is actually the ability of the individual to follow the process. If you have good individuals but do not want to follow the process, right, but you want to have a larger proportion of your decision-making capability through the art part, not through the science part, then it doesn't go well.
So actually, I want to ask you this. We do know that a lot of investors, I mean, we all make mistakes with our investments. You make a bad choice, you make a mistake, you lose some money. How do you deal with mistakes and errors? And from that, what can our viewers learn with dealing, about dealing with their own mistakes? Because we'll make mistakes, we'll lose money. It's important to quickly move on and not to lose an opportunity in either the market or any other form of investment by sort of bogging yourself down with that mistake. How do you talk your fund managers out of their mistakes?
The first and foremost principles which we built in our fund house, you have to first focus on your success story. The more the time you spend on your success story, the more time you spend on actually what is contributing well for you, then the number of time it is spent actually is more on success stories and a disproportionately higher, then automatically your failure levels will go down. That's one. Second principle which I applied is failure has to be used actually for the purpose of learning. Failure should never be used actually for the purpose of driving you away, creating a fear factor. Fear factor is the worst enemy as far as the portfolio manager concerned. So any fund houses, when you run actually money management, I cannot have a fear. But at the same time, the fear not having does not mean I'm complacent. That means I should have the mindset actually go back and learn from that mistakes and then not to repeat those mistakes.
But I want to ask you this. We have a lot of viewers who are retired who use debt funds to generate a regular income. Now they're slightly worried about the fact that we're looking at a lowering interest rate regime. I want you to tell us what your outlook is on debt funds for the next year or so, and would you recommend that our retired investors continue to use debt funds to generate an income, because then they will see a shrinking income in terms of what they're making. What is the best way right now for me to manage my retirement corpus in debt?
See, clearly mutual funds are the best product in a falling interest rate scenario. Of course, even in the rising interest rate scenario, mutual funds remain as the best product.
Yes.
As long as you rightly said, the retirement money. Retirement money means that money is meant for the longer term, except you need some money actually on a month-on-month basis for your monthly expenditure.
Without actually losing out to inflation.
Without losing for inflation.
Yes.
And second is the mutual fund products are the best product to help you save tax arising on account of the income adjusted for inflation, and it gives you the benefit.
But should all my money be in those debt funds?
Definitely.
All of
the
it?
answer is why the answer is yes. If you put it in fixed deposit, there's a general tendency for investors to look at fixed deposit either as a 3-year or as a 5-year. So nobody goes and actually puts money beyond 5 years.
Nobody does a 10-year deposit.
Not many actually put for 10-year deposits. Most of the people either 2-3 years or 5 years, and then every 3 years they want to take the money back and then reinvest money for another 3 years.
Yes.
But eventually they themselves will not realize they are actually in totality
Lost
they would have
money.
stayed invested for 10 years or 15 years the same fixed deposit. Where they would probably lose is on an inflation adjustment, which doesn't happen there. You have to pay full tax. And secondly, the interest rates coming down, the mutual fund actually benefits out of the form of capital gain, with the benefit they may not get it. At the same time, when the interest rates comes down, they also may not realize the deposit rates also do come down.
Okay, so I'll make this simpler for our audience to understand before we take a break. Let's assume I have retired right now. And just to make the calculation simple, I have 1 lakh rupees that's come out of all of my retirement corpus, which I now have. I need to be able to invest it, A, to generate a monthly income, and to make sure that 10 years from now, because of inflation, my 1 lakh is not now valued at 70,000 rupees. So how do I break up this? How would you break up this 1 lakh rupees for me? Would you put it all into a short-term debt fund?
Yeah, see, if you are conservative investors and you want income only from this investment, not the capital gain like in equity,
Yes.
then you can put all your 100 rupees, 1 lakh rupees in the fixed income schemes.
Okay.
And assuming you get average of say 9% return on that, the 9% in the end of 10 year, assuming the inflation is say 8%, and you have to pay tax only on the 1% extra return that you earn more than 8%. That means you earned your inflation, plus you are getting some extra return in the form of tax adjustment. Whereas in the case of a simple coupon bearing instrument, whether in FD form or any other market instrument form if you put it, you don't get to adjust that inflation as well, adjustment factor. So that's the beauty of it.
All right. So we're going to have to take a very quick break, but a quick takeaway is to just keep your investments as simple as you would like it, and that's the most important thing when it comes to managing money. Quick break. We'll come back and talk to Bala about specific equity funds from the Birla Sun Life basket. That's on the other side. Welcome back. You're watching a very special episode of Investors Guide. We're in conversation with Bala of Birla Sun Life Mutual Fund. Bala, you have some very interesting funds in your portfolio. Some of them, like you were talking about before the break, have consistently done well. The Birla Sun Life Frontline Equity Fund, for example, is a top performer, 5-star rated fund. And I know that we have a lot of viewers on this show who invest in that fund. What is your message for viewers? I want you to help them understand how you run that fund and what your philosophy is for that fund going forward for the next 10 years.
I think Mahesh Patil, who is the CIO equity,
Yes.
who has been managing the fund for the last 12 years, and with a lot of discipline. I mentioned
Is that part of the beauty that you've managed to retain talent like Mahesh for 12 years and there hasn't been too many changes in your fund management team?
No, touchwood, God has been kind, and there's absolutely no change in the leadership team. Fund, as per the overall the style of investing, very clear mandate is how much of the portfolios of this fund has to have linked actually to the linkage to the BSE 200. So how much is the outperformance I need to generate, and for which what is the kind of allocation I need to have with respect to the index weight versus this portfolio weight. That's the first and foremost discipline. And second is the portfolio manager also is extremely nimble-footed in order to ensure that the fund actually delivers consistent investment performance, for which you need to beat the benchmark by about 3 to 4%. So if you keep that as a benchmark, irrespective of whatever the market in which you are operating, and you are able to deliver the longer term performance.
But your personal favorite for your own investment is the mid-cap fund.
Exactly.
Tell us why the mid-cap fund and why not frontline equity?
So frontline, of course, is a large cap. It does have some allocation from me as well. But I prefer to have investments in mid-cap for one simple reason: a big alpha. If you are not worried about the market fluctuation, and if you are not worried about asking a question, is the large cap is good, or the mid-cap is good, or small cap is good, as long as you don't have those questions going in your mind, and mid-cap is the one which I think on the basis of bottom-up approach can give you a significant alpha over the large cap funds.
You know, this is the thing. A lot of viewers, like you said, right, they view mutual funds in equity as very risky. They view mid-cap equity as extremely, extremely risky. So there is a very small group of people who invest in mid-cap, and even within that group, it's a very small exposure.
Correct.
Do you think there is a need for us to increase our exposure to mid-cap mutual funds, like you yourself have done?
Definitely.
What is the ideal exposure? Like, again, let's take a 10-year time horizon for retirement. What is the ideal exposure to a mid-cap mutual fund within that portfolio?
See, ideal exposures, you need to be overweight, of course, on equity, first and foremost.
By
And
overweight,
second
you
is
mean 60%?
by 60%.
By 60%.
I think for every 100 rupees of investment, maybe you can put 60 or 65 in equity and 35 of course in fixed income schemes or mutual fund. Within the 65, you can have almost about 30% large cap. You can have almost about 45% in mid cap.
Okay.
And balance 30% you can have it in balance fund.
Okay.
And this combination,
The balance fund is also then adding to your debt component
it
a little
does.
bit because it is some 30% debt.
The way I look at it, it actually answers all the three questions that goes in the minds of people most of the time. Sometimes people say large cap is good, not necessarily I know the answer all the time, right?
Yes.
And sometimes people say mid cap is bad, therefore don't invest.
Yeah.
And sometimes they also come back and the mid cap will do very well. So that question, I think the question answers just keeps going and oscillating. At times people also discuss about how much is the cash I should own.
Yes.
If you have to find an answer for all the three,
You should have
if you have a combination of these three, the large cap takes care of your potential mindset that you have that is risky, that takes care of their allocation, that you want to actually generate longer term return really well, therefore mid cap takes care of that. Now whatever the question that comes to your mind, should I have another allocation, reduce my allocation equity or increase allocation debt and so on and so forth, that is taken care of the balance fund.
You launched a banking and financial services fund. Now, it has done well.
Correct.
But the banking sector has given a lot of investors a lot of sleepless nights. What is your view on this fund? Would you say investors should stay invested? If we are looking at the portfolio you just described, does it require a banking and financial services fund in that portfolio? Have you personally invested in it?
I have personally, of course, invested.
You have?
I have invested. I think banking and financial services fund, the year we started in 2013,
Yes.
it's a proxy to the economy. So as we all witnessing today, NPAs issues that is hitting actually the public sector banks is a proxy to the economy, right? So therefore, it has a true nature of being proxy to the economy. That means if the economy does well, banking and financial services fund have to do well.
And as an equity investor, you cannot hide from the
You
economy.
cannot hide from that.
Yeah.
Having said that, I mentioned about earlier science and art. This fund is a true example of the science and art combinations of investing in market. And why I am saying this specifically, since when we launched this fund, we remain underweight on public sector banks. There is absolutely no doubt that the private sector banks have done very well during this period. Those who are focused on retail side of the market, and those who are focused on wholesale banking side of the market, and they got beaten down in the last 20 years because of the slowdown in the economic growth, and therefore on account of their arising NPAs issues, they're all hitting actually the banks which actually had a lot of wholesale banking relationship, and they're the one got hit. But this fund completely underweight on the segment.
Let's also talk about your MNC fund, which is a very, very interesting fund. It's done well. Again, I want to understand what your expectation is from this fund for the next 5 years.
See, we are quite bullish on, especially on multinational companies, and that's why we build a reasonably big size in this fund.
Yes.
One simple principle, these are the companies who are here for long term.
Yes.
Secondly, they are well governed companies. The businesses are actually in the business that have got a longer term sustainable business model. And third is the parentage commitment in building a business across the global market is quite high. And therefore, the multinational companies, we actually are quite bullish in the MNC fund which are operating. Even when you look at investing in these companies, again we bring that science and art part, what to let go and what to invest in that. And on the basis of that, the way portfolio has been constructed today between various segments of the market, and we actually chosen only those companies in those sectors which have got the greater future on one side. Other side, the company also have got relatively a cleaner balance sheet and cleaner business model and better governance, and the commitment actually to the company that has the listed space also is quite high.
Are you expecting double-digit growth from these companies?
Easily. I mean double digit, maybe lower double digit number.
Because just and correct me if I'm wrong, just from description that you've just given us, if a multinational company based in India long enough to be listed on our stock market, we're looking at returns of 8 to 12%, lower double digits like you said, and I know you're not allowed to say so, but is that the kind of return expectation on the fund as well? Then in that case, it's a direct derivative of what the company
No,
gives
these
you.
were the same expectations we had about 4 years back.
Yes.
We always used to say it can give the return in the range of about 13-14% kind of thing. We used to always believe that. But in reality, they outperform the market significantly. And to my surprise, this fund has outperformed all the funds, including a diversity equity fund, in the large cap category and multi cap category and mid cap category. And
At a time when the market was doing very badly also.
At the time, the market was doing very badly. That's the quality of these companies.
What is the investor profile ideally for your MNC fund? What kind of investor should I be? What kind of expectations should I have? Should I, be prepared for volatility, or am I the kind of investor who expects a certain kind of return?
See, this fund may not have too much of volatility, but this fund at times may test your passions of not giving a return.
Yes.
But that does not mean the underlying portfolio will not give a return over the longer term. So therefore, the investors have to look at this fund as long as you want to invest and sleep over it, and for till your retirement, till you attain your age of converting into something else, then you can stay invested in that.
If I'm a young, aggressive investor, and there are plenty of them right now, 24-year-olds, 23-year-olds, investing from, the first 6 months of their first job. And it's such a fantastic, feeling to get an email from someone young who wants to invest his her first paycheck. What kind of a fund should I be investing in then? If I'm willing to, lose some sleep over it, but I want aggressive, I want strong returns, what would you recommend from your basket?
You should choose mid-cap fund and then leave it at that.
Okay.
Because he is anyway coming for a longer term. Age is in his favor. For the next 35 years, he is going to work and earn actually. So therefore, why to bother? So in the 30-year period, if a fund manager, portfolio manager like us, if I are able to invest in the right businesses, a business that can deliver over the longer term, then he doesn't need to worry. He has to take the bet. But even investors at time have to also take the bet, and then only I think they will get actually the best of their investments from the return point of view from the equity market.
This is the other conversation that we must have. Brilliant product. Mutual funds right now, I think, actively managed the most efficient product available to the Indian investor across the board.
Right.
Yet somehow the exposure or the number of people investing in mutual funds is so low. It's not even just a question of educating, tier 2 and tier 3 India. A lot of times people in urban India are not using these funds. What are we doing as an industry right now to introduce people to the beauty of mutual funds?
I think a lot of things is happening. One, of course, is the awareness program that is being conducted by all of us, including Birla Sun Life mutual funds. I've been doing across the country multiple format events to get investors on board.
Yes.
Second is even regulation. Of late has permitted getting customers on board at ease. If you're an Aadhaar card holder, you can actually get yourself KYC completed and start investing up to 50,000 rupees in mutual funds. This is again another way to actually get customers on board. And third, of course, is the making investors to buy. If I already have investments in fund and equity and my experience is good, then why not look at mid-cap fund? Why not look at the balance 95 kind, which is nothing but actually a cross-sell and upsells kind of product. Yes. I think we are doing a lot of work in terms of educating investors. Don't stick to only one fund. You also have a diversification within the same fund houses by investing in multiple products.
Last question. I know that you personally also invest every last rupee of your savings till your bank account comes down to zero, from what I understand, at the end of the month.
That's right.
For someone who's not doing it right now, or who's possibly waiting to accumulate a certain amount of money and then start investing, what is your advice?
Accumulation need not be done necessarily through your bank account, which is bad. I mean, the more you accumulate in your bank account, you can only see a big balance, but that does not give you much return.
But you're actually losing money.
It's losing money. Therefore, any money that is there, you start investing it the day you get the money in. So either in the form of a liquid fund, you can start with that and then move into the equity gradually, or maybe move into the fixed income schemes gradually. But the factor is get all your money into the liquid fund, and from there, I think you start investing in that. Also remember, at any point of time you have a need for money, you can just put a redemption request and get the money, and the very next day, in the case of debt fund and liquid fund, within 3 days, as it works in the stock market, in your even in equity schemes. Therefore, absolutely don't need to worry about whether the money will come on time or not. All
right, Bala, I wish you very, very good luck with the company and all of the funds that you manage, and I thank you for your time.
Thank you. Thank you. My pleasure.